we like every protocol we innovated quite a lot. Our lending market. So initially we launched only as a lending market. We launched DEX only after 9 months or so. So the lending market has the highest LTVs and lowest liquidation penalties in the industry. How is that achieved? We created a new type of liquidation engine, which is up to 100 times more efficient than what we have on the market. On the market. That's why now we have up to 95-98% LTVs. Liquidation penalties are as low as 0.1%. This is not achievable by anyone else.
Before we begin, I want to give a shout out to our new sponsor, SocialValue, an AI-powered investment research terminal with prop indices and a high-performing DEX on its own chain. Join its third research competition for a $100,000 prize pool by submitting on socialvalue.com or on BidClub.io, with an additional chance to win another $2,000 every 2 weeks. GM, we're live. Welcome to another episode of Bitcast. I'm your host, Jason Kam, aka at Maple Leaf Cap. Not the typical setup. I'm in a different setting, and the setting goes back to professional maybe in the next few episodes. But today is August 26, 2025, 6:30 p.m. Hong Kong time. Bitcast is being live streamed to BidClub members. Questions are from the members and my own. This is not financial advice. Today I'm speaking with DMH, the COO of Fluid. DMH, welcome.
Hi everyone. Hi Jason. It's a big pleasure coming here. Thank you for the invitation.
Yeah, I found you guys. I followed InstaDev for a long time, and then I found you through a BidClub thesis. So the numbers are pumping. Every time I look you guys up. So I'm keen to hear the story. Maybe just to start, why don't you tell us a bit more about the transition from InstaDev to Fluid? Because I think that's a story that not many people are privy to.
Yeah, sure. To give more background, first of all, like Fluid protocol is fully built by InstaDev team, and it's the same people, same team, and we kind of transition our branding from InstaDev to Fluid, and we're focusing on Fluid mainly. But how we came up with the idea of Fluid? So back in 2017-18, we built InstaDev. Back then there were like only 2 DeFi protocols, Compound and Maker, and we were building a middleware protocol for interacting with other protocols. And then some other protocols came, and we were just a middleware, like a front end with advanced features like refinancing, like flash loans and stuff, for using these different protocols. But we realized that there is a lot of room for improvement. But in order to innovate, we have to build something of our own. We couldn't innovate by building on top of others. We had to build something of our own. And in 2021, we came up with the idea of Fluid, and we started building Fluid. We were building it for more than 2 years, and it was like fully in stealth, let's say. Fluid was announced only in October 2023. And in 2024, we launched Fluid. In 15 months, we grew to 3 billion market size, which is sort of a success, but below our expectations at the same time.
And sorry, the launch was basically mid-24, even though the announcement was late 23.
It was 24th of February, so you can say like March 2024.
Yeah, and InstaDev was no longer actively maintained, I'm guessing. The whole team's attention is on Fluid now.
It's in maintenance mode, so we are not adding new features, but if there are any things that have to be changed, for example, Aave is making some new, Aave is launching Aave v3, v3.1, 3.2 and stuff like that. We have to do some updates on our side, or Morpho reached out to us, they asked to do some updates. So we're making these updates if needed, but we are not like working on new features from our side. So it's like purely in maintenance mode.
Got it. And then basically there's a transition from InstaDev token to the Fluid token. I guess, is there any burn in the interim? Like, how is that transition like?
Yeah, so transition was just the token was just renamed. So we didn't issue new token. We didn't lock users, we didn't dilute users. It was just on-chain renaming, so users didn't have to do anything from their side. The token was just renamed on-chain.
Got it. Oh, okay. very straight. And InstaDev today is not generating any much revenue, I'm guessing, to your $10 million per annum.
InstaDev, we made it free. After we launched Fluid, there was some little fees at InstaDev Pro. We made it free. We actually, like, since we started InstaDev, we've built 4 different protocols. It's InstaDev Pro, InstaDev Lite, which is an important piece, and now it's called Fluid Lite. We built Avocado Wallet. It was the first, I think it was the first smart account wallet back then, and we built Fluid. Avocado Wallet is sort of in maintenance mode as well. We didn't work on its distribution, but we are, as a team, is using Avocado Wallet all the time. So it's our multi-sig. We're deploying all contracts. Like, we're using exclusively Avocado Wallet for all our operations.
Yeah. Got it. I think this is an interesting design choice you guys took, because I think allegedly it's what got you to the current growth and market share today. At least the high-level understanding I had is that people can deposit really closely similar collaterals, USDC, USDT, and then when they borrow, the debt itself is also kind of you don't fix yourself to one type of collateral or one type of borrowing. You can the mix shift happens when people trade against the LP pair, and in exchange for that uncertainty around the collateral and borrowing pair that you have, you earn additional fees on the swaps. Therefore, it not only lowers the borrowing cost, it also kind of juices the overall yield of the protocol, and that's how you got kind of the market share that you have today. Is that sort of a right characterization of how you got the growth today?
I would say it's only one thing about Fluid. Let me start one step back. What is Fluid? It's very, very important to understand that Fluid is not a lending market. Fluid is not a DEX. Yeah, we call Fluid a liquidity layer, and on top of liquidity layer we build protocols. We build first lending market, so people are saying, okay, Fluid is lending market. Then we build DEX, people are saying, okay, Fluid is DEX and lending market. And then we'll be building more protocols on top of Fluid liquidity layer. And every protocol that we build on top, it contributes to the same liquidity layer, and it utilizes the same liquidity layer. So protocols are built on top of this big existing liquidity pool. Yeah, liquidity layer, just like one simple smart contract with all tokens in there. And every new protocol, it grows us horizontally and vertically at the same time. We start, offering more services, and at the same time we're growing our existing liquidity. And it makes the protocol, the more liquidity layer grows, the more efficient is the protocol. It's very important thing to understand about the architecture of Fluid. And then on the protocol level, in every protocol we innovated quite a lot. Our lending market, so initially we launched only as a lending market. We launched DEX only after 9 months or so. So the lending market has the highest LTVs and lowest liquidation penalties in the industry. How is that achieved? We created a new type of liquidation engine, which is up to 100 times more efficient than what we have on the market. That's on the market. That's why now we have up to 95-98% LTVs. Liquidation penalties are as low as 0.1%. This is not achievable by anyone else. Then we launched the DEX. The DEX is highly integrated with the lending market. So the DEX can utilize debt from the lending market as a liquidity. The best example here is our USDC DEX pool, which has $125 million of DEX liquidity, but it has zero TVL. Yeah, nobody can provide TVL to the DEX pool. The liquidity is created out of the debt. And on any other DEX in existence, if someone wants to have 100 million DEX pool, people have to bring $100 million in cash. We have this extreme capital, infinite capital efficiency, because we utilize debt from the lending market. And then, our lending market is powering our DEX, and our DEX is powering our lending market. Like they are very symbiotic. And referring to what you said, yeah, we can use Fluid DEX LPs as a collateral on the lending market. So, for example, SUSD USDT LP token from the DEX can be used as a collateral on the lending market, and this LP token will be earning both trading fees and lending APR. So, for example, USDT lending APR is 5%, then LP liquidity provider will be earning this 5% on USDT. He will be earning SUSD native yield, and he will be earning trading fees, and he is now able to borrow against it. He can borrow normal tokens like USDC, USDT, or he has an option to borrow, say, a smart debt. What is smart debt? On the UX level, a user is borrowing USDC or USDT or both tokens, USDC and USDT. For example, he borrowed $1,000 of USDC, but his debt, and he has this $1,000 of 1,000 USDC in his wallet. He can do whatever he wants. He can off-ramp, swap, leverage, trade. Like it's in his wallet. It's his money. But his debt will be denominated in both USDC and USDT, and his debt can be changing from 100% in USDC to 100% USDT on any other composition based on the activity in the trading pool.
Yep.
So now his smart debt, he's paying borrowing APR to borrow stable coins, but he's also earning trading fees. And how trading fees are generated on the debt? Debt doesn't have TVL, so how the swap is happening? When user is borrowing smart debt, he accepts that his debt can be in one or another token, so in USDC or USDT. So trader now can basically trade on top of his debt. When trader is swapping USDC for USDT, he is repaying one part of the debt and borrowing another part of the debt on behalf of the borrower. So he's swapping 100 USDC to let's say the debt now is denominated in like 500 USDC and 500 USDT. And trader is swapping 100 USDC to 100 USDT. The trader is repaying one part of the debt, so he's repaying USDC debt, and he is borrowing another part of the debt.
Yep.
So he's borrowing USDT debt on his behalf. So now his debt is 400 USDC and 600 USDT. And minus the trading fee. So let's imagine trading fee $1. So it's $1 less now because trader paid trading fee for changing the composition of someone's debt, and trader made the swap.
I guess the borrowing cost reduction is proportionate to that borrowed pair as a percentage of overall USDC USDT pool.
So the borrow cost reduction, it's a function of volume, fee, and like liquidity in the pool. So
okay,
the more is
I get it.
The bigger is liquidity, and the lesser volume, the less is the APR, and so on.
I guess roughly today, let's say the cost to borrow USDC USDT is like 5 to 7%, roughly similar to, because that factor is driven by looping, right, of USDE today. Roughly speaking, on the current transactional throughput in the DEX side, how much is the reduction of borrowing costs on this platform?
Yeah, so first of all, like it depends on the pair. If we are speaking about like USDC USDT on mainnet, it's a very, very competitive space. So USDC USDT DEX pools on Ethereum are very competitive. You have Uniswap, you have Kubo, you have others, you have Fluid. So on Fluid, trading APR on your debt is around 0.4-0.5% now. So this is 0.4-0.5% reduction in borrowing fees. But sometimes, like I remember on Arbitrum, there was a situation where trading fees were higher than the borrowing APR. So people were basically getting paid to borrow on Arbitrum. Like, something like it was, let's say, 3% borrowing APR, 3.5% trading APR. So people were getting paid like we're getting half percent.
Yeah, I guess in those situations there is so much, like the aggregator routes so much volume to the Fluid DEX that in a short period of time, the swap fees outweighed the borrowing costs on that chain.
Exactly. Like we don't have actually a front end for Fluid DEX, so all volumes that are coming to Fluid are coming through the aggregators or bots or whatever. I'm actually checking now what is the trading APR on Smart Depth on Arbitrum. It's 1.8%. So the actual borrowing APR is 5.4, but the trading APR is 1.8. So your net borrowing APR is 3.6. This is a big reduction. Yeah, it's like almost 2% reduction. This is like quite a lot.
Yes, and I guess the impermanent loss, quote unquote, because the borrower are effectively, well, the lender and the borrower are effectively accepting the potential inconvenience of getting back their collateral or repaying their debt in a slightly different instrument that they borrowed or lent, right? And for that, they are enjoying a slightly kind of higher lending rate or a slightly lower borrowing rate. Is that roughly the right idea?
Yeah, exactly. So it's like a DEX LP risk. When you are providing liquidity on the DEX, what's your main risk is that you can be fully in one token or another. Regarding the impermanent loss on stablecoin pairs like USDC, USDT, I think it's mostly like irrelevant because I mean, like, in general, people don't care if they borrowed, say, 1,000 USDC.
That's right.
And in the worst case scenario, they will have to repay 1,000 USDT. But normally it doesn't happen. This is not a big risk. Where permanent loss matters if people are borrowing different, volatile pairs. If they're borrowing, let's say, lending ETH USDC, DEX LP, and borrowing ETH USDC Smart Depth, then there is, of course, a lot of impermanent loss, but there are also a lot of trading fees. And like professional LPs, they know how to hedge these risks, and they might be able to make money out of this. One thing to know that DEX V1 is not very good for volatile pairs. DEX V2, which is coming soon, it will be very, very good for the volatile pairs.
And that's what I was going to ask about, which is Fluid DEX V2. That allows the user to self-define the two pairs they want, or if they don't mind the collateral or the borrowing to be swapped into.
So what DEX V2 will allow it on DEX V1, you cannot select your own ranges on your collateral on that. So the range of the pool is predefined. It's set when the pool is created. Let's say the whole range is plus minus 10% or plus minus 2%, whatever. So the range is predefined, and LPs cannot select their own ranges. What DEX V2 allows, it allows for three very big things, important things. First one, users will be able to create their own ranges on both collateral and depth side. So you can basically, like on the collateral side, you can think it's like you use UniV3 where you select your own ranges on your DEX LP. But on the depth side, users will be able to actively market make with their depth. Imagine you borrow ETH USDC Smart Depth. You have these tokens in your wallet, you do whatever you want with them, but your depth, like you're actively market making with your depth. You select your own ranges, your own ticks, and you always know what your liquidity profile will look like at any given price of the assets. So it's it opens so many opportunities for the LPs as soon as they realize how to utilize these tools. So this is like selecting their own ranges on collateral and depth side is one thing. Second important thing is that DEX V2 will be cross-collateralized. So how Fluid works now, you have one collateral and one depth asset. It can be one smart collateral, one smart depth, but it's always like Vault always has two assets, like one collateral and one depth.
So just to be very clear, it is like ETH and like some staked ETH or something, and then the other side is USDC, USDT, and that's all you can do.
On DEX V1, yeah, you can put one collateral. It can be only ETH collateral, USDC debt, or you can put smart collateral like ETH stake ETH, smart collateral, and USDC USDC smart debt. Yeah, but like this type of combinations. But you cannot put ETH and BTC and SUSD. Like for example, on Aave, you can have multiple different collaterals, then you can have multiple different debt assets, and you have some health ratio and so on. On Fluid, it's sort of like a vault system where you have one collateral, one debt. Yeah, so with DEX V2, what will be possible? Users will be able to cross-collateralize their position, so they can bundle multiple collaterals and smart collaterals on the collateral side. They can bundle multiple normal debts and like range orders on the debt side. So your position can look like, for example, ETH BTC smart collateral, SUSD normal collateral, and BTC normal collateral. And on a smart debt, you have normal ETH as debt, you have USDC USDT smart debt, and you have ETH USDC smart debt. And all of this is bundled as a single position.
But in that situation, my ETH or BTC will not be swapped into like some other token. It will still be ring fence between like wrap BTC and something other BTC, right? Like my overall BTC count will not be reduced.
So if you have you have this bundle position, if you have only BTC normal collateral, it will stay only as BTC normal collateral.
Sure.
If you add some smart collateral, for example BTC USD, then your BTC USD smart collateral, it can be it can change from full BTC to full USD based on your range that you select.
Oh wow, I see. Okay, so it's like okay, so when it's like smart debt or smart collateral, it is no longer a like-kind pairing. It can also have like basically impermanent NOS enabled pairing. So I can have smart collateral of BTC ETH, BTC USD, ETH USD, like a bunch of random stuff, and also on the debt side, and I'll be basically my collateral base and my debt base can be highly impermanent losing. But obviously, and I can define range, but the fees will obviously be a lot higher.
I mean, it will not be obviously, it might be, but actually, on DEX V1 we can also have this volatile pairs. We have ETH USD C, but the problem here is LPs cannot select their own ranges, so it's not a good product for volatile pairs. With DEX V2, they will have full authority over their pairs, how the liquidity profile will look like, and so on. So what I was saying that on DEX V2 you can bundle your positions, so you can have normal collaterals and smart collaterals at the same time, bundled as one position, and but then you don't have to cross-collateralize all your positions. For example, you want to have some separate position, for example, SUSD collateral, USDC debt, as a separate position which not be cross-collateralized. You just open it as a separate collateral and debt position. So you will have both options to cross-collateralize your position or to keep them isolated. So that's
the second part, right? And there's a third part to this.
So the second part, and just to add more on the second part, like this opens so many possibilities for liquidity providers which they were not having before, and we are very excited to see what strategies and ideas people will come up with. I think it will take some time, but it's a very powerful tool for them. And then they can also do hedging on the same venue. So for example, now, like how most LPs providing liquidity on Uniswap, they have one leg of their position on Uniswap and the second leg of their position on, let's say, on some perps or options protocols, sometimes on the lending markets. Now you will be able to put your DEX LP as a collateral, and at the same time you can hedge directly on the same venue, so you don't have to put your to split your asset between different venues. So you have ETH USDC smart collaterals, and you borrow normal ETH you sell it, you short it, so you reduce exposure to volatile asset of your collateral, and then you rebalance your position according to your strategy. So you can do this kind of strategies, and there are like really a lot of opportunities for LPs. And the third thing which I wanted to mention, that DEX V2 will allow for any kind of AMMs. On launch it will support like Uniswap style, like UniV3 style of AMM, but in theory it can support any kind. It can be curve, it can be something new, it can be any kind of AMM can be supported.
When is it coming?
So it's coming likely in September, maybe early October. Actually, like I should tell you more. It was almost ready in June.
Yeah, I think you were guiding it to July, and then you pushed it.
Yeah. It was actually like sort of ready in June. It was like already under audit. I remember at ECC, it was in the beginning of July. I met our auditors, and by that time they already audited the code, and they gave me some, they gave a lot of compliments to the code base. So early July it was already audited, but we were also trying like to launch Fluid on Solana, and we were also targeting July. So we decided, okay, we first launch on Solana and then we launched DEX V2. Solana took a little bit more time than we expected, so we launched private beta on Solana by the end of July, like first day of August or like last day of July, something like that. And then we were expecting to launch on Solana on 14th of August, but something got delayed, so it shifted to 20th of August. Something got delayed again, so the launch is finally tomorrow. So we're launching Fluid
Solana.
So okay. Fluid on Solana will be tomorrow on 27th of August.
Oh, okay, cool.
So because of these things, we would like delaying DEX V2. So now we're launching on Solana. Then we need some time to stabilize the markets on Solana to make sure like everything is smooth, that's no risks and so on. And after that, we are ready to launch DEX V2. Also, because like the code was ready since June, we were like our devs were just thinking what else they can add, and they were slowly adding a few more features. So now we are sending the code for re-audit, so to verify some new changes. And we still have a few more ideas that we can add to the code base before we launch it. Late September, early October, we are ready to launch it. There is one more consideration that we are thinking about, that we're keeping in mind, that we might want to first make sure that all integrations with all DEX aggregators, with all arbitrageurs and bots are live before we make the DEX V2 live in public, because when we launched DEX V1, it took 3 months to get all the integrations, and before until you get all the integrations, you don't get all the volumes. So we will probably start working on those integrations around mid-September, and if they take 1 month, then we'll launch mid-October DEX V2. If it takes little less, we will launch earlier. So we'll see how much time it can take. But what you need to know is that code base is ready since some time, but we're just delaying it ourselves.
DEX V2 is also going to be on Solana in October.
So DEX V2 will be live on Solana a little bit later this year.
But this year?
Yeah, this year. We expect by December or something.
Okay, got it. And I guess the Jupiter tie-up is part of the integration with the aggregator that you talked about. That's why you have a 50-50 fee share.
So the reason why we have a 50-50 share with Jupiter, we say earlier this year, in January, we realized that Solana ecosystem is growing fast. It does, TVL is growing. It does really a lot of DEX volumes. and we also realized that lending market landscape is not so mature there, and we have an opportunity to go to Solana and become the biggest lending market there very fast. With the DEX that we have, we realized that we should become the biggest lending market there. And launching the DEX there will also make a lot of sense because the volumes are very high on Solana. But what we also realized that coming to Solana as an Ethereum protocol, like a very Ethereum native, without knowing anyone in the space, and becoming like an alien for Solana community, it will stop our growth. It will be a very big problem for our growth. But at the same time, we are in very good relations with Jupiter team, and we realized that we should try to collaborate with them, and we spoke with them. They were also excited about this idea, and we decided, okay, we'll bring the tech, we do them, like we build it ourselves, everything, and they and Jupiter team will work on growth and distribution, because Jupiter has all the distribution on Solana. This is the front end of Solana de facto. And so this is how we decided to go. And so they do BD growth side, we do the tech part.
Okay, I have some questions around that, but this is interesting. So I want to talk about numbers for a second because it's really timely. I want to rattle off some numbers and then you can tell me if it's right or wrong. But it's about 3 billion in TVL, and then $500 million to $1 billion of volume per day, 90 million in annualized fees, but about $8 to $10 million in revenue, probably annualizing towards $20 million now. Is that roughly correct?
It's like last time I checked, the revenue was 19 million annualized. Let me check it right now. What's the latest? Yeah, it's 18.5 now, so it went a little bit down, so 18.5 annualized, like on 30-day average.
Can you bridge for me on how that 3 billion in TVL and 500 million to $1 billion of volume translates to 20 million in annualized revenue?
Surely. So how lending market generates revenue? It charges lenders a fee. Yeah, so for example, borrowing APR is 10%, and let's say utilization is 100%. We take 10% cut from that to lenders, and lenders get 9%. Yeah, borrowers pay 9%, lenders get borrowers pay 10%, lenders get 9%, 1% we take as our fee. It's 10% reserve factor. So whenever people are borrowing on Fluid, we get a cut of revenue cut from that. Most of the profit is coming from stable coins borrowing, because stable coins have higher rates. Like if people borrowing ETH, like ETH borrowing rates are like 2.5%. So the revenue is lower there. So most of the revenue is coming from the stable coins.
Yes, and and on that 3 billion TVL, how much is borrowed?
Let me check it right now for you.
You probably have it handy.
It's around half of that is borrowed, so around 1.5 billion, 1.4, 1.5, so approximately 50% is borrowed.
Got it. So 1.5 billion borrowed. I don't know what the blended cost is, but let's call it like 6% or something. If I'm not and then you take 10% of it. That's like $9 million a year.
I mean, very napkin math is like that, but I can give you exact numbers, but I can not online. Yeah.
It's fine. And then the other 500 million to $1 billion of volume. How does that bridge to your revenue?
Yeah, so there is one more. On the DEX side, we already have a 25% revenue card for on the stablecoin pairs. For our stablecoin pairs, like 75% of the fees they go to liquidity providers, and 25% of the fees goes to us. The thing is that stablecoin pairs, they have very low fees. Low, like stablecoin DEXs are super competitive. Like when we launched, you know what happened when we launched the DEX? we started
I don't
getting
know.
a lot of volumes.
Yeah.
And I mean, we launched the DEX in November last year, and after that, like we started getting out of volumes, and others they started lowering the fees because we were like taking a lot of market share from them, and then volume started leaving us, so we had to lower our fees as well, and then it became, it became a race to zero. Like everyone started lowering the fees, and now everyone lowered like the fees on the stable, like on the USDC to 0.005% or something like that.
0.005.
Yeah,
0.005%. Okay.
Yeah, so like super low fees, and making money from stablecoin pairs is not very easy.
Got it.
So it's 0.0005%. So it's like 4 zeros total. So we're not earning much from the DEX as of now, but the DEX also generates a lot of borrowing demand. $300 million are borrowed through the DEX pairs, which is also like a value add for us. And with DEX V2, when we will have volatile pairs, they generate a lot of trading fees. When we start charging a cut on the trading fees from volatile pairs, this is when we'll start scaling our revenue massively. We have plans for that. The thing is, like, we just have to finally launch DEX V2 to get liquidity there and start charging a fee. So by the end of the next year, there is like, there are some estimations that we can, have up to 200 million in revenue for the protocol, mostly coming through the DEX V2. And there is also one more source of revenue for us. This is Light protocol, which I mentioned in the beginning. Light protocol is basically a yield strategy. Our Light protocol is live for many years, like for 3 years, I guess. And Light protocol has always had like one strategy, which is a strategy like yield strategy on ETH. What we are doing, we have an automated strategy for leveraging ETH, also for providing liquidity for ETH, stake ETH, and we also have a few more tools that allow us to generate even more yield on ETH. And Lightvault has also $3 billion in ETH. This is separate from our TVL, like we're not counting it as our TVL. So it has $3 billion in stake ETH minted. And we generate we generate a lot of revenue from, like, basically our Light revenue is the same as our as revenue from the Fluid protocol, from like lending market and the DEX. So Light protocol has the same revenue.
Wow.
But at the moment it contributes a lot. In the future it will be a tiny part of our revenue. But we are also planning to launch USD Lightvault. So add one more product, and it will also bring us more revenue. And what is important, it will help us to keep utilization rates on Fluid for stablecoins very, in the optimal way.
So sorry. So annualizing 20 million, does that count Light or no?
Yes, it counts Light.
Okay, so it's like 10 million from Light, 10 million, and like 9 million from Light and 9 million from Fluid, and then maybe 1 to 2 million from the DEX currently.
So currently analyzed is 18, so we can say it's let's say 8 from Light and 10 from Fluid, something like that. Again, I can give you more accurate, like we have a separate dashboard with all the revenue. It's it shows exactly how much money coming from every protocol, from every asset. It's like very detailed, but approximately Light revenue and Fluid revenue are the same.
Got it. And that's the revenue. How much does it cost you to operate the team today?
We're, let's say, very lean and cost-effective team. The annual expense is like around $3 to $4 million,
Yeah.
but we do not charge DAO for these expenses. Because I mean, like, we raised back in 2019, 2021.
Yeah.
We raised money. Then we were very, let's say, strategic with the way how we measure, like, let's say, company treasury.
I see.
What we were doing, we were buying ETH.
Oh, very smart. How big is that treasury now?
Let's say there is Fluid treasury, like, which is DAO treasury, which is around $14-15 million now.
Yeah.
And there is company treasury,
Yep.
which is like not public. Again, like, the thing is that there is no, let's say, equity behind Fluid and stuff like that. So
Sure.
basically, the team which is working on the Fluid, I mean, we can say that we are DAO members. Yeah, we're contributors to the DAO. But the thing is that we're just not charging the DAO fees at the moment because, like, we raised before. We don't. We have, like, very big runway, like for 4+ years, I would say.
Yeah. Got it. Okay.
Yeah, and
So
like
you're wealthy enough. You're wealthy enough that you don't have to ever sell the tokens, like to fund your operation.
we don't have to sell the token to fund the operations. If we want to sell the token to make one more raise, it will be for expanding the team.
Got
So
it.
we think that in the next 12 months we will expand the team massively, maybe double the team in size, maybe open a dedicated office and things like that. And the reason for that is because we can do so many things at the same time. At the moment we're launching on Solana, we're launching DEX V2, and we're working on few minor things at the same time. But we can build many more protocols for Fluid, and if we expand the team, we'll be able to ship the protocols faster and build more protocols at the same time, which is, I would say, important.
Are you emitting any tokens to achieve this kind of ARR numbers?
Yeah. So we started using Fluid token as an extra incentives. Maybe December last year. So for the last 11 months, we started using Fluid as incentives. We use it only in one place. It's only for USDC and USDT lenders. So we don't have any incentives on the DEX side. We don't have any incentives on the borrowing side, on bringing us ETH, let's say, and stuff like that. The only place we put incentives is USDC and USDT lenders, and it's very. I can easily explain you why. Because Fluid, if you from the lender's perspective.
Actually, sorry, I don't mean to cut you off. We're running a little short on time, so why don't you give me how much token is emitted? Because I want to get to the growth and the upside of the story, if it's okay.
Yeah, it's around 15 million annually in token
Tokens
incentives. Yeah, in token incentives annually.
$15 million or 15 million tokens?
Dollar value.
Okay, got it. Yeah. Got it. So it's like 3 million, 2.5, 3 million Fluid tokens.
Yeah, I mean, the current price is 2.
Okay, so 2-3%.
Yeah.
Okay.
Yeah.
So you're kind of breaking even, if I have to guess. The AR that comes in kind of offsets this amount.
Yes, I mean, we can say so. Yes.
Interesting. Any idea to sunset this incentive?
So yes, and no. I mean, yes and no at the same time. Actually, we started again, why we're doing incentives in the first place. From the lender's perspective, you have option to go to Aave or to Fluid for the same, let's say, 5% lending APR. But always people will choose Aave because Aave is 7 years on the market. Aave is the most liquid market like in the world. I mean, in DeFi world.
Yep.
And I mean, it's just the most reasonable thing you can do as a lender. Just go to Aave. So to attract USDT and USDC lenders to Fluid, we have to give them more. And the way we can give them more is only by like just giving them extra incentives. We cannot charge borrowers more because then borrowers will say, okay, like I don't want. We still actually our borrowing costs are normally higher than on Aave, but we still have the borrowers. But if we charge too much on the borrowing side to compensate lenders, then borrowers will not come. So we have to attract lenders in some way. The only way to attract lenders is to give them extra incentives. When we launch Fluid, we launched it in March 2024, and we started Fluid incentives only in December 2024. For the first 8 months, we were using only like liquid asset, like a USDC and USDT from the Treasury, to attract lenders. From December, we started using Fluid token, and in the future, we of course we don't want to have much inflation. The thing is that we had more than 40% of Fluid supply in the Treasury, so we had to spend some of it. And in the future, as our revenue grows, like for the next 6 months, we have like very big expectations how much the revenue will grow. Then we can start using our liquid assets as incentives again, or we can start buying back more tokens than we use as incentives. This is also an option, to have net positive impact.
Yeah. So that's the exciting part. There's a very visible path of Solana bringing significant volume, and then V2. It seems like it would be cost competitive because of the swap fees that would come in. I saw the growth vision and community buyback proposal. Why don't you tell me a bit more about kind of maybe fast forward to end of next year, right? You have good launches on just the Solana and DEX V2 alone. What would that mean for your revenue, and what would that mean for your transactional volume and TVL if you hit your target?
Yeah. So one thing to keep in mind. How will the market behave? Will the market grow as it goes now? Will it stay the same? Will we have more adoption from, let's say, institutional finance, where they bring more TVL, they bring, let's say, tokenized stocks becomes a thing in DeFi and so on. These are things which we don't know. Also, let's put aside all the new protocols that we're launching. Let's speak only about Fluid lending market and DEX and our Solana deployment. The bear case scenario for me, the worst possible, is 15 million in revenue, annualized revenue, and TVL. I would say, 6 billion TVL. That will be the absolute worst. What I can see in 2026. I would say this is sort of a failure, for me personally. If we achieve 6 billion TVL and $50 million in revenue,
that's with Fluid going to zero. That's with Fluid going to 15 with some DEX revenue.
Excuse me, come again?
That's with going to zero, but it's Fluid and DEX only.
Light. Let's say Light will have the same revenue as it has now. Let's say $8 million a year.
Okay, so you're already above that today, right? It kind of tapers off to 15.
I was saying 50. So
50. Oh, bear case is 50. Yeah. Oh wow. Okay.
Yeah.
I see.
Yeah. So for me, the bear case is 50 million, 50 millions in annualized revenue in 2026 and 6 billion TVL. This is the worst case scenario for me.
And that's and just so I understand, that's $10 million plus of DEX revenue. Is that fair to say?
Actually, the DEX revenue, I would expect
a lot higher.
Will be
a lot
higher.
Yeah. So it's 20 million Fluid, 8 in light, and then like 20, 22 to 22-ish. Yeah.
I mean, revenue from the DEX, I would say at least 30 million.
Wow. Yeah.
Yeah, but I expect much more. Again, this is like if things go
that's a bear
wrong or
case.
something. Yeah.
Yep.
For me, it's bear case. The bull case, the revenue will be 200 plus million a year. This, if like all things go right, if DEX V2 gets a lot of adoption, it becomes, because we expect that DEX V2 will become the biggest DEX by volumes across all chains combined within 6 to 8 months after the launch.
Wow.
And I believe we have, I think we have all the, all the rights to believe in that. Given how, like DEX V1 was a concept, and we see how concept proved itself. Actually, 2 weeks ago there was the first day when we flipped Uniswap in daily volumes on Ethereum, and this is with very limited amount of DEX pairs available on Fluid. This is with only stablecoin pairs, with no volatile pairs, and DEX V1 is not like is not so optimized as DEX V2 will be. So we know that the concept works, and we make DEX V2 much more advanced, and we bring new tools to liquidity providers that are not available now. So with DEX V1 we were already able to make it the biggest on Ethereum for one day. With DEX V2 we expect it to become constantly the biggest on Ethereum and on other chains as well.
What would that translate to in terms of market share on Ethereum and Solana with that 200 million revenue in terms of for the DEXs?
You mean volume market share?
Yeah, like if you make $200 million in revenue, right? Like right now, you're like 25% market share in stablecoin volume, like you said in Ethereum. Like, what would $200 million? Yeah.
Sorry, like on Ethereum stablecoin market share is more than 50%, I guess. It's 55%.
Yeah. So what would $200 million in revenue mean then? Because you must basically dominate all the other pairs that are not stable.
Yes.
Okay.
Yeah, exactly. So I would say Uniswap made $1.5 billion in trading fees last year. If we're saying that we become as big as Uniswap in volumes on EVM side, and we also, let's say, generate $1.5 billion in trading fees, we take 10% cut from that, from the fees, it will translate into $150 million in revenue from the DEX alone on EVM side. But we'll also have a DEX on Solana. That's one thing. Second thing that we expect, like the DEX share to grow over the next year. But so this is like this is why I'm saying this, like bull case scenario. If everything goes right,
I see.
it will become the biggest on EVM. We also launched DEX on Solana, and DEX is like volumes on Solana are bigger than on EVM. Also, it's important to understand. And DEX revenue, DEX volumes grow overall, then we can grow to this 200 plus revenue by end of 2026.
I see. And let's say if you get there, what happens to, I guess, the buyback? Like, if you actually hit 50, 100, 150 million of revenue, I guess in your mind, what would happen to the tokenomics of the business?
So regarding the tokenomics, so currently there is a proposal on the forum, like exploring like how we should proceed with the buybacks. And I was even surprised that there are like quite a few people saying like there shouldn't be buybacks. Some people are saying there should be. I was thinking that everyone will want buybacks. If we proceed with the buybacks, again, depends what will be the model. Most probably it will not be like a fixed percentage of revenue for buybacks. Most probably it will be like scaling the the bigger the TVL, I mean the bigger is the FDVs, the lower are the buybacks. The lower FDV, the higher are the buybacks. Most probably it will be this kind of like buyback model, but like still to be decided. The only thing that we say gave deadline that like by 1st October we have to start with the buybacks if the community wants it. So we don't want to keep this.
By 1st of October of this year.
Yeah. We don't want to keep this conversation forever. Like we have to decide and then proceed like by October 1st. And also what we are saying that let's start the buybacks and evaluate after 6 months what how much benefit does it bring to Fluid DAO. I'm fine. There are people who are saying like buybacks are bad because you have to reinvest into the growth and things like that. I think buybacks is still good approach.
Yeah.
Because if you buy back the tokens, you can decide later what to do with them. You can reinvest them, you can burn them, you can distribute them, whatever. So if you're buying back the tokens and keeping them, you still have this flexibility to do something else, and you can still use tokens for the growth. It's not like it's not possible to use them for the growth. So I'm positive with the buyback idea. We're still gathering more feedback. We started gathering feedback privately before we made this proposal in the forum, and again, some people were saying no, buybacks is the worst idea. And I was speaking with many founders of other protocols. I was speaking with some investors. They all of them had really different opinions. Quite fascinating that there is no common opinion on this yet in the space, which is interesting to experiment here.
What range do you feel like the buyback would come out at? I understand it's a percentage of revenue, and higher FD might be lower percentage, but is there a range you have in mind? Is it 0 to 100%? Is it more 20 to 60%? Roughly speaking, where do you think it would fall?
Yeah, initial idea was 100% to 0, let's say. So if FDV is, let's say, lower than 1 billion or lower than 0.5 billion, whatever, we use 100% of the revenue for buybacks, and as the revenue, as FDV grows, the revenue percentage is going down. I mean, the buyback percentage goes down. But again, we got some feedback from other people who says, okay, you're capping the growth of the token this way because people will only buy when you're buying a lot, and when you're not buying, people will not buy. So there are different, and I agree with that, by the way. It makes sense, and they offered some different solutions. So we're still gathering feedback, and we will see what's the best way, to buy back.
I know you're very excited about Solana and DEX V2, and that's you've shipped it. You're going to launch it. You're going to do growth efforts on it. But I guess what's really exciting, and I guess is not in that $200 million bull case target, is you could build other stuff, right? Like you said at the very beginning, it's a liquidity layer at the bottom, but you can build apps on top that utilize such liquidity. What is the one or two most exciting things the team could build or potentially working on that could make this even bigger?
Yeah, I will tell you. We have several ideas in mind, in early R&D process. First one is permissionless lending and borrowing markets. What it will unlock, Fluid, we cannot have, let's say, exotic collaterals on Fluid. Actually on Fluid we have the least amount of collaterals among all major lending markets. With permissionless lending borrowing markets, we will be able to have let's say, exotic collaterals, so not so mature collaterals. And for the protocols for asset issuers, it will unlock both lending and borrowing markets, as well as it will unlock this extremely efficient DEX for them. So they will get both permissionless lending borrowing market and permissionless DEX, which work together. It's very big value add for them. That's one thing. Second thing, which I'm quite excited about, is fixed rates. So fixed rates lending, borrowing, sort of PT assets on Pendle. It's a very big market now, and this market will only grow. I expect. And at the moment there is not so much competition on that. And if we launch this, let's say permission, like if we are launching this fixed rates, then we also can cover end-to-end journey of the users, where they can, buy tap into the fixed rates and then lend it, borrow against it on Fluid directly. And if you combine it with permissionless lending and borrowing markets, then any token issuer then he can come create fixed rates for his asset, then create lending borrowing market and create a DEX, and it covers the whole primitive for them. And the third thing, which we slightly discussing within the team, is the perps protocol. I'm the one in the team who wants to delay perps, because I'm thinking that growing perps is extremely complicated. This is the most competitive thing in the space now. And you have to create something which will be so much better than competitors have. And even after that, you still have to work on the growth side a lot. And growing perps is very different than growing DeFi protocols, because it's a completely different audience. At the same time, I realize that perps can bring a lot of revenue. We can see, of course, I'm not even speaking about Hyperliquid, which is earning billion plus a year, but even smaller perps, which have very few percentage of market share, they earn quite a lot now as well. So I would say I would love to have perhaps sometime later, when we have a more concrete idea how we can make it, the best perps in the space. Our CTO, he's more bullish on the perps. He's more willing to build them, but probably it will be a little bit later, maybe 2026.
I see. What's the timeline for the permissionless lending and borrowing and the fixed rates?
Yeah, so at least one more major protocol will be built by the end of this year. I mean, this is rough timeline.
Audited and shipped, and people can start using it.
Yeah. This is the internal timeline. I mean, what we were discussing, but we were discussing this before DEX2 got delayed and stuff. So in the worst case scenario, it will be Q1 2026. But if things go right, if things go well, we'll try to launch it by the end of the year. But if not, then Q1 2026. But another thing is DEX and Solana is launching by the end of the year also. So we always build something. We never have free time. Always doing something.
Yeah. And what's the heuristics? If your range is $50 to $200 million by the end of next year, how much do you think these two efforts would bring to that number, to that range?
Permissionless markets and I don't think much, to be honest. If you look at Pendle, which has $10 billion in TVL, they don't generate much revenue.
It's small overall speaking. It's
small. Permissionless lending and borrowing markets, I don't think it will grow bigger than current Fluid deployment. So I don't think these things will bring really a lot of revenue. But what I think, why I think permissionless lending borrowing markets are important, because it brings a lot of network effects. Yeah, if you start working with curators, if you start working with more protocols, more people know about you, you tap into their community, so it brings a lot of network effects. This is why I like this permissionless lending borrowing markets. I know for some of these permissionless lending borrowing markets that are live now, curators, they bring a lot of, let's say, deal flow to these protocols, and they have a vested interest in helping these protocols, this permissionless lending borrowing markets to grow. So that's sort of that's the main idea behind it, I would say.
We covered a lot of bases. I feel like we ran through the numbers. I feel like there's a string of catalysts that gets you to maybe 3xing to 10xing your revenue in maybe 14 to 16 months. There are some new efforts that you're working on. Is there anything else that you think is really exciting but we haven't covered yet?
Oh, for me, like Fluid itself is so exciting. Like I can speak about it for hours. I think what it's doing, it's super important. But let me add one more thing. So we're trying to work more on the distribution side of things, and I would say that like our collaboration with Jupiter on Solana is our first, let's say, pilot program. To get more distribution. So basically Jupiter is our distribution partner, and as you know, there are like a lot of new chains are launching, like chains from some fintech companies, from some CDFI companies.
Sure.
And we can say that most of these chains are, let's say, like commodities, and it's possible to work with this chains like on some exclusive basis as well. So we're skipping a lot of conversations now on working with them on exclusive, let's say, with some exclusive conditions where they become our de facto like distribution partners. We bring them the best tech, we bring them the best protocol in DeFi which can host any kind of protocol in the future. So if they need something specific, if they need perps, or if they need fixed rates, or they need whatever, we can work with them closer and like build it like for their specific needs. And all liquidity will be consolidated in one place, so they don't have, say, if they need, say, one DEX and one lending market, they need like to bootstrap liquidity in the DEX, they need to bootstrap liquidity in the lending market. If we bring Fluid, they just bootstrap one protocol and they grow all protocols at the same time. So we're speaking with some of these partners, and we want we understand it's like either like we come and collaborate with them, or we don't come there at all. So it makes sense for us to give up part of the revenue to launch with some their branding and so on, but capture that market rather than like just leaving that market for someone else who will come and like and make a deal with them. So I cannot like confirm or deny anything or something, but yeah, we're speaking with different partners. Hopefully, probably like we'll have some news in the future, but it depends.
Interesting. But the BD effort, I guess other DeFi protocols are also working on, like Aave, Athena, Uniswap. I guess the valid prop of picking you as exclusive partners, you'll give them fees versus they'll just take it for themselves through permissionless deployment, but also you only need to bootstrap it once. Is that basically the valid prop?
Yeah, so I think the best thing is that they have to bootstrap one protocol, and they will need to work with only one team instead of working with like 5 different teams and making these 5 different teams to work between themselves. In this case, they can work with one team very close and have the best tech on their chain, and yeah, they can get the revenue share, if like some commercial details. Some other commercial details, but yeah, we're happy, to work closer with them.
Got it. Okay. This is really helpful. DMH, thank you so much for your time. I think we're trying to get it out there in the next 1 to 2 days. Really appreciate it.
Yeah, thank you so much for your time. I mean, it was a pleasure speaking, and I really love to speak about Fluid. I wish we had more hours available. Yeah, thank you for your time. Thank you, for the audience who will, use their time and read, who will watch this podcast, who will read the thesis on the BidClub. And yeah, I mean, looking forward to chatting with you more. And if anyone of, if you or your audience, if you or your audience want to know more and speak more, I'm always available, in my Telegram or whenever. I'm happy to walk through the protocol, to discuss anything. Yeah,
great.
Thank you.
Thank you so much. Bye bye.